Hello, welcome back. So in today's video, I'll be talking about my buys in this earnings season, as well as some stocks that are interesting to look at right now. So for reference, this is my portfolio. It was my portfolio a few weeks ago, and currently this is my portfolio. So I've increased my position in MSCI as well as ASML. These two companies are the companies that I bought a bit of in this earnings season. So I bought these two stocks, MSCI as well as ASML. So I'll be talking about MSCI first. So MSCI stock actually dropped around 10% on earnings itself. The stock dropped despite a good earnings report. So the stock dropped because of post-earnings profit taking, apparently. The company also dropped because there was a cautious management tone. So while not overtly negative, the company's leadership hinted at slower subscription growth, a key revenue driver. And Evercore ISI also downgraded the stock, citing concerns over plateauing growth and saturated markets. So there's a lot of emphasis over here being placed on the subscription number. So let's take a look at the subscription number. So your subscription number, your total annual run rate for this subscription portion of the business is actually up around 7% this quarter. So year on year it's up around 7%. And over the past few years, this is actually the lowest growth that we've seen from the organic subscription portion of MSCI's business. And the key reason why the growth has actually dropped is because of the ESG portion of the business. So under Biden, under the Democrats, a lot of emphasis was being placed on ESG. But currently now under Trump, we're seeing a lot less emphasis being placed on ESG. I mean, he's actively trying to reduce all those clean energy sources, as well as things that are related to your ESG. And that's why we're seeing declining growth in this segment. But for MSCI, it is a quality business. I mean, if you have to look at the net income, this is MSCI's net income. It's just stellar. It's going up to the top right. And the ROIC, ROCE, ROA, they're all incredible for any given company. I mean, even if you halve MSCI's ROIC, it will still be levels above an average S&P 500 company. So your average S&P 500 company has around a 9% ROIC. MSCI has around triple of that at around 26%. And overall, this company is just a high quality compounding machine that dropped for a slight deceleration in terms of growth. So for MSCI, this is my valuation for the company. So assuming a 12% free cash flow growth from year 1 to year 10, and assuming a 4% terminal growth rate, this company's fair value is closer to around $600 a share. And on the earnings day, it actually dropped to around $525 to $535 a share. That was when I picked up majority of the MSCI shares that I got that day. So for MSCI, at current prices, you're getting it at around a 10% discount. And I think for a quality business like this one, there's a decent buy right now, and that's why I added to my position. The next portion that I'll be talking about are some undervalued stocks in the market as well as their thesis. So the first stock is actually called SiriusXM. This company is up around 7% year to date. It has no P ratio because the earnings are negative. It has a dividend yield of around 4.5%. So for SiriusXM, this is their business model. What they do is they operate satellite radio in your cars. So imagine your Tesla cars on the road. A lot of them have actually a SiriusXM radio being installed there. They also have a subscription platform, and they're trying to expand into YouTube as well. So you're seeing a lot of those SiriusXM radios being broadcast on YouTube as well. So in your satellite radio space, SiriusXM is actually a monopoly. But of course, it is in a sunset industry. The industry will likely see a decline over the next few years because of other streaming services like Spotify coming up. So for SiriusXM, this is a possible thesis for the company. So the company has negative net income because they shot satellites up in the sky. So every few years, the company has to shoot satellites into the sky, and that will cost a lot of money on them. And that's why the net income became negative. They also had an asset write-down, so that's why the company's net income is negative this year. But you can expect that net income to turn back positive this year as well as next year. And for SiriusXM, they're currently trading at a price to free cash flow of around 10%. So the company has a free cash flow yield right now of around 12%, and historically it has never been this high. So historically the company has always traded at a 5% free cash flow yield. So assuming that the company can continually buy back shares, continually give out dividends, you could easily see a safe 10% return from this company just from the buybacks and dividends alone without the multiple expansion. Of course, if the company resumes back to growth again, then we could see a lot of multiple expansion, and that's why Warren Buffett actually bought into this stock, and he currently holds a sizable amount in this company. The next stocks that I'll be talking about are your healthcare insurance companies. So Canteen today actually reported earnings. After that earnings, the stock actually dropped around 10% and currently is up around 4%. So for Canteen, this is their earnings report. So they reported 48.7 billion in revenue for the quarter, exceeding expectations by 4.5 billion. but the company's earnings actually swung negative, so it reported 0.16 EPS loss per share as compared to $2.42 EPS a year ago. So they say we are disappointed by our second quarter results, but we have a clear understanding of the trends that have impacted our performance and are working with urgency and focus to restore our earnings trajectory. So this is what the CEO actually said during the earnings call. So she said that the headwinds, the 2025 headwinds, your ACA risk adjustments and redeterminations are fixable and mostly front-loaded. They're repricing 100% of the exchange book for 2026 and are confident it will turn back to profitability. She also pointed to operational levers in Medicaid like utilization management, fraud controls, and rate advocacy already being implemented in high pressure states like Florida and New York. So for insurance, there are two different types. There are short tail as well as long tail insurance. So for a lot of your healthcare companies, they operate in a short tail insurance model. Basically, the insurance only covers for a year or so, and after that year, they can increase the prices to basically curb any margin pressures. And that is what the CEO over here is saying. The CEO is saying that they're trying to reprice everything so that they have adequate amounts of margin coming in next year. And for all these insurance companies, they'll be allowed to increase the prices because there's a minimum margin that they need to earn in order for them to operate, which the regulators acknowledge. And that's why I think your healthcare insurance stocks are undervalued today. I mean, Canteen is a company that is currently trading at around 10 times earnings. United Health is trading at 11 times earnings. Elevance Health is trading at 10 times earnings. All these insurance companies have historically traded at between 15 and 20 times earnings. So at its current price today, a lot of them are undervalued. But of course, you have to wait this one out. As for United Health, they have the Medicare fraud portion, which could be a bit of a challenge. And what the management says on Tuesday, they'll be reporting their earnings on Tuesday, and we'll have to see how bad their guidance is on Tuesday as well. The next stock that's interesting right now is Lululemon. So Lululemon year to date is down around 41%. Stock is currently trading at a 14 times earnings. So for Lululemon, I can see a parallel being drawn right now. So another company, which is Deckers, at one point was down around 50%. It's currently down around 30% year to date. The stock beat their earnings and the stock is up around 12% today. And it is currently trading at an 18 times earnings. So it's trading at a premium as compared to Lululemon. So for a lot of your different clothing companies, including Deckers, including Lululemon, they dropped because the tariff rates were extremely high. So they have a lot of factories outside the US. So for example, Lululemon, they have factories in China, they have factories in Vietnam. Deckers have factories in China, Vietnam, and Sri Lanka as well. And there are very high amounts of tariffs being placed on all these different countries. So China at one point was at 67% reciprocal tariffs, and then you had Vietnam at 90%, and that was what led to the stock dropping. So with the earnings expectation low this quarter, as well as next quarter likely, you could see all these companies like Deckers, like Lululemon beating them, and that's what Deckers did today. So for Lululemon, it is currently trading at a 15 times earnings. While I don't think the company is high quality, while I don't think the company is a whole over the next 10 years, it is definitely presenting a decent buying opportunity now if you're looking for an undervalued stock in the retail space. But for me, I'll be avoiding this one. I look for high quality companies, not fair companies that are trading at a discount. So for Lululemon, it is a stock that I'll look at, but I'll not likely invest in it. So the next company that I'll be talking about is Adobe. So Adobe is down around 16% year to date. It is currently trading at a 23 times earnings. So for Adobe, I mean, this is incredible fundamentals. You probably can't find a better company with better fundamentals. So the company has just amazing growth. I mean, if you have to look at this earnings per share growth, there's just a straight line to the top right hand corner. So for Adobe, the thesis could be something that is similar to Google. So it could be that it is another company where the AI risks are overstated and the earnings just keep coming in. The company keeps beating earnings. And that could be Adobe's story as well over the next few quarters. And for Adobe's valuation today, after adjusting out stock-based comp, the company is now priced at 8% free cash flow growth over the next 10 years. So if you think that Adobe can grow at more than 8% over the next 10 years, then I think it is an amazing company to look at right now. I mean, it is probably one of your laggards in your S&P 500. And for this stock, priced at 8% free cash flow growth, I think the stock is undervalued today. I'll be holding off this stock for now because Google is cheaper and it is another company that is at risk with AI. But for Adobe, if it gets unreasonably cheap, I'll be looking into this one for sure. If the company beats earnings again and then the stock drops another 20-30%, then it could look interesting at its current valuation. Last portion, I'll be covering some questions left in the comments. So the first one, it says, what would you say is a good price to buy into Visa? So for Visa, this is my EPS calculation for it. So assuming a 13% EPS growth and assuming a 28 times earnings for Visa, I mean the lowest point for Visa was in 2022 when it dropped to around a 25 times earnings during the 2022 bear market. So at its current price today, it is overvalued, but I would look to add into Visa at around $300 a share when it can give me around a 12% CAGR over the next 5 years. So for Visa, I view it as overvalued today. Hopefully they miss their earnings so that the stock can fall a bit, and it will look interesting again. The next question, it says, can you rank the attractiveness between Copart, MSCI, Booking, Moody's, as well as Apple? So this will be my rankings. I mean, MSCI is up there. Copart is the next one. Copart is presenting a decent opportunity now. I think it is currently trading at around fair value also. As for the other 3 companies in this list, I think they are overvalued. So Booking is overvalued, of course. Moody's is overvalued. Apple is overvalued as well. Ranking them based on quality, I think Moody's and Apple are almost on par. I'll place Moody's slightly above Apple. I mean, I own the company, of course. So Moody's will be 3rd place, Apple will be 4th, and then Booking will be in last place. I think Booking is overvalued today. It has the weakest moat amongst all these companies here, and that's why it's in the 5th place. For Apple, it is a company with very little growth, slightly lesser growth than Moody's, and that's why it's in the 4th place. As for Moody's, it is simply one of the highest quality businesses out there, and that's why it's in the 3rd place despite the overvaluation. I hope you guys have found this one useful and invest safe.